Yo, what's up, everybody? It is Wednesday, May 31st. So the market was down today. A lot of the usual suspects, Fed rate hike fears, that sort of thing, and also everybody waiting on the passage of this debt ceiling situation that finally they vote on that and they get the debt ceiling raised. If the debt ceiling is not raised, then, like I said, then, we're going into a recession. We need those the payment flows, those monthly payment flows. They are critical to sustaining a positive growth rate in the economy. It's not going to be a big growth rate. We're talking about 2.5, 2.7%. That's not bad. Okay, that's basically been the average over the last 30 years. But that's what we need. Now, the interest rate stuff is completely overblown. If you look at a graph of the stock market, if you look at a graph of the NASDAQ or even the S&P over the period of time when the Fed started raising interest rates last March, we've recovered basically all of that, not to new highs in the S&P and the Dow, but practically to new highs in the NASDAQ. So the interest rate thing has been a positive, and that's something that I said all along. I've been the only person out there that I know of, even from the MMT crowd, maybe with the exception of Warren Mosler. He tweets some stuff from time to time. But I've been the one who has been consistently saying that the fiscal flows from rate hikes are just going to expand. And with the new debt ceiling agreement, okay, so there's not going to be an increase in discretionary spending in 2024. There'll be a 1% increase in 2025, but not defense spending is subject to can be increased, and Social Security and Medicare, those non-discretionary items, they're going to go up, and they've been contributing a lot. And the interest situation is just going to get more positive. That's what I said yesterday, that a lot of we're only a little bit more than a year into the Fed's campaign, and a lot of the bullish impact still hasn't even been felt, because when if you're talking about longer dated securities, like the 2-year, 5-year, 10-year. Those have to mature. As they mature, depending on when they were issued, then they get rolled over at a higher interest rate. So that's just going to keep accumulating. The one thing I forgot to mention yesterday, and I do think this is something to think about, and I have to think about it because I kind of forgot about it. It was off my radar screen, but that is the end of the moratorium on student debt payments. That's part of this debt ceiling agreement, is that students are going to have to start paying their debts. And that could have a solid impact to personal consumption expenditures. We haven't had that in place now for like almost 3 years. I got to think about that one. It's something that I kind of have kept left out of my analysis, not on purpose, but it just kind of skipped my mind. But that will have an impact. The impact might be absorbed or offset by, the interest income transfers from the Fed's rate hikes. But it is something. And it's going to need to be watched, because we have some room in GDP growth. It's not like we're at 0.5%, but 2.7%, you start to chop away at that. If that happens, we could get down to some pretty slow GDP growth levels. The other thing, though, that I've been saying is that I think that, first of all, before I get into that, let me just mention that these next couple of weeks are going to be, bad for the stock market, just because we're first going to be hitting the June corporate quarterly tax drain on June 15th. So, I mean, whatever volatility that we're feeling right now in the stock market, we haven't even hit the period when you're going to have an actual drain. I mean, yesterday I was talking about the foolishness of, when they raise the debt ceiling, Treasury's going to have to immediately raise, 300-400 billion, and that's going to drain out the cash. It doesn't change the financial balances of the economy. All it does is a recomposition of the financial assets. Okay, you have less reserve balances and more securities, which can be posted as collateral for stocks. As a matter of fact, a friend of mine pointed out that back in 2001, when Mnuchin's, Treasury Secretary Mnuchin, and they were going through the debt ceiling at that time, he ran the thing all the way up to 800 billion in issuance, and the stock market took off. I mean, so there you have it. There's the example right there. But so that's not something to think about. And the quarterly corporate tax drain, I mean, that's something that happens every quarter. We go through that, and that does have an impact, because that's an actual removal of financial assets. Okay, that's not a recomposition or just a change in the composition of financial assets held in the economy. It's a draining away. I mean, that's taking the swimming pool level down. But like I said, the government's running right now at over $1 trillion deficit. We have still 4 months left in the fiscal year, still 1/3 of the fiscal year left. So we'll be well over we'll be like 1.3, 1.5 trillion. I mean, that's plenty of, addition to the swimming pool is what I'm saying. You could see right now that Treasury issuance is up like $500 billion over last year. You might say, well, how can that be? Well, it can be because we're spending more now than we were. We're deficit spending more now than we were at this time last year. So the government's been adding financial balances to the economy. That's what's kept us out of the recession, and it's the reason why I said, going way back, we're not going to have a recession in 2023 unless they don't raise the debt ceiling. So they're going to leave this to the last second, like they're always going to do. But I just wanted to mention that student loan thing, because I forgot to talk about it, and it will be something that I'm going to reflect on further. And I'll give you my feelings about it, when I think about it a little bit more. But I don't know when that kicks into effect. I think that might be in October or something like that. And the good news is, I give my subscribers the numbers, the flows every single day. I mean, there is no organization or outfit out there that I know of on Wall Street or anywhere else that does what I do in terms of tracking these flows, not on a monthly or a quarterly basis, on a daily, every single day. Like, here's what went in, here's what came out, here was the balance for the day. I mean, nobody else does that. I'm the only one who does that, and that's why we're ahead of the game. We're always ahead of the game, because I see these flows every single day, and I see how they're trending, and it's able to tell me exactly what's going to happen to the economy, almost to the degree of giving me, kind of very close to being exact readings on growth rates or lack of growth. I mean, I know this because, I put this information out every day. So take advantage. Sign up for MMT Trader. Go to my website, pitbulleconomics.com. Sign up at least for a 30-day trial and check it out. I'm the only one who provides this kind of information, and this is invaluable information. It is the core. I've said before. I've said this many times before. It's the first derivative. It's the core of all other analysis. Everything else flows from that. So when you have that, then you could project out all these other economic indicators that we get from the government, that most economists on Wall Street, or I should say all economists on Wall Street, you know, they're the ones, those are the indicators they chatter about every month. But I already know, like we know, because I see it every single day. Like if you're in business and you see, you know, your customers bringing in X amount of cash every single day, you know what your month is going to look like before your accountant does. So I mean, that's exactly the same thing, and that's the exact analogy that I could use. So, and I'm the only one that does that. So anyway, that's it for today, folks, and we'll see what happens with this debt ceiling. And like I said, I'm going to think some more about this student loan situation and what kind of impact, what kind of negative impact that's going to have. All right, have a good one. Bye.